Gold prices are moving again, not dramatically, not suddenly, but steadily enough to attract attention. Investors are watching closely because gold is not just a metal, it is a signal of confidence, a signal of risk, a signal of uncertainty. Right now, the global economy is not collapsing, but it is not relaxed either. Inflation has cooled, interest rates remain elevated, geopolitical tension remains present, and financial markets are sensitive. This is the environment where gold matters. Historically, gold rises when confidence falls, not instantly, but eventually. The first factor affecting gold prices is interest rates. Gold does not pay interest, so when rates are high, cash becomes attractive, bonds become attractive, money flows toward yield, and gold faces pressure. This is why gold sometimes falls even during uncertain times. It is not weakness, it is competition. Competition from safe assets that generate income. The second factor is the US dollar. Gold is priced in dollars. When the dollar strengthens, gold usually weakens. When the dollar weakens, gold usually rises. Right now, the dollar remains strong. Global investors continue buying U.S. assets. This supports the currency and limits gold's upside. But there is another force: central banks. Across the world, central banks are still buying gold, not for profit, for protection. They are diversifying reserves, reducing reliance on a single currency, preparing for long-term risk. This demand is quiet, but powerful. It does not chase headlines. It builds position slowly. Now, look at the stock market. When markets feel stable, investors reduce gold exposure. They move toward risk, technology stocks, growth companies, innovation sectors. But when volatility rises, the behavior changes. Investors seek safety. Gold becomes a hedge, not an investment, a hedge. This shift can happen quickly, sometimes within days, sometimes within hours. Another factor is inflation expectations, not current inflation, future inflation. If people believe prices will rise again, gold demand increases. If inflation is expected to fall, gold demand weakens. Expectations drive behavior, and behavior drives markets. Now consider geopolitical risk. Conflict does not always push gold higher immediately. At first, investors seek liquidity. They hold cash, they wait. But if uncertainty persists, gold demand increases because trust becomes fragile. Trust is the foundation of financial systems, and gold is insurance against lost trust. Today's environment is complex. Economic growth continues, but debt is historically high. Interest payments are rising, government spending remains elevated, financial markets are strong, but volatility is frequent. This combination creates tension, not crisis, tension. And tension is where gold lives. Now, the key question: will gold prices go up or down? The honest answer depends on three things: interest rates, inflation expectations, and global stability. If rates remain high for longer, gold may move slowly. If rate cuts begin later in 2026, gold could accelerate. If geopolitical tension intensifies, gold demand could rise quickly. If stability returns, gold may consolidate. Markets do not move on prediction, they move on reaction. Right now, gold is not signaling panic, it is signaling caution. A reminder that risk still exists, even when headlines look calm. Gold does not replace growth, it protects stability. It does not create wealth, it preserves value. That is its role, and that role becomes important when uncertainty rises. The global economy in 2026 is stable but sensitive, strong but stretched, growing but cautious. This is the type of environment where gold remains relevant, not because disaster is certain, but because risk is never zero, and smart markets prepare before problems appear. If you want to understand where gold goes next, watch policy, watch inflation, watch confidence, because gold follows trust, and trust is the most valuable asset in any economy.